The problem isn't inflation. Everyone blames inflation. The price of eggs, the price of rent, the price of everything, always creeping upward year after year. But inflation isn't actually the biggest threat. It's just the smoke. The real fire is somewhere else entirely, and once you see it, you can't unsee it. The story everyone believes. Here's the story most people carry around in their heads. Prices go up. The Federal Reserve raises interest rates to cool things down. Borrowing gets more expensive. People spend less. Demand falls. Prices stabilize. Crisis over. It's a clean story. It's the story taught in economics classes, repeated on the news, and printed in 1,000 headlines. Inflation is the villain. The Fed is the hero. Interest rates are the weapon. And for decades, it's mostly worked. Or at least it's worked well enough that nobody questioned the deeper mechanics. But here's a question almost nobody asks. If inflation is simply a problem to be solved, why has it kept coming back, generation after generation, no matter who's in charge, no matter which party controls Washington, no matter what tools the Fed uses? You don't get a recurring symptom without a recurring cause. Why that story is incomplete. Let's try a different question. Not why do prices rise? Everyone already thinks they know that one. The real question is this. Why does the system seem to need prices to rise? Because here's something strange. The Federal Reserve doesn't actually target zero inflation. It targets roughly 2% inflation every single year as a matter of official policy. Think about what that actually means. The institution responsible for protecting the value of your money has as its stated goal a plan to slowly erode that value forever, on purpose, by design. That's not a bug. That's the blueprint. So if a small, steady amount of inflation is deliberately built into the system, the real mystery isn't why prices rise. It's why the system was built to require that they do. To understand that, we have to follow the money somewhere most people never think to look. The hidden system nobody notices. Imagine a country as a giant household. It earns income through taxes. It spends money on programs, services, and salaries. And like most households, sometimes it spends more than it earns. Now imagine that instead of cutting spending or raising income to close that gap, this household discovered something extraordinary. It could borrow money almost indefinitely, and the interest on that debt could itself be paid for by borrowing more. That's not a hypothetical. That's the literal structure of how modern government finance works. The U.S. government currently owes more than $39 trillion. Just the interest on that debt, not the principal, just the interest, now costs over $1.2 trillion per year. That single number has grown so large, it now exceeds the entire U.S. defense budget. Let that sink in for a second. The government spends more simply servicing old debt than it spends on the military. And every year, the government runs a fresh deficit on top of that, spending roughly $1.9 trillion more than it collects in tax revenue. To cover that gap, the Treasury sells bonds, essentially IOUs, to investors, banks, foreign governments, and increasingly the Federal Reserve itself. This is the system nobody points a camera at, not the stock market, not the unemployment rate, the bond market, the place where trillions of dollars in government debt gets bought and sold every single day, quietly setting the terms for almost everything else in the economy. And once you understand how this system works, you start to see why inflation isn't just tolerated. It might be necessary. Why governments need inflation. Here's the part almost nobody explains clearly. Imagine you owe $100,000 on a loan. Now imagine that over 10 years, inflation quietly erodes the value of a dollar, so that $100,000 today only feels
like $70,000 in purchasing power by the time you're done paying it off. You still owe the same number of dollars, but those dollars are worth less. In real terms, your debt shrank without you paying a cent extra. Governments carrying trillions in debt benefit from exactly this mechanism at a scale almost impossible to picture. A little bit of inflation, sustained over decades, quietly shrinks the real burden of government debt, even while the number on paper keeps climbing. This is why a certain amount of inflation isn't treated as an enemy of the system. It's treated as a release valve for it. But a release valve only works if you can control the pressure, and that's exactly where things start to get complicated. The debt spiral, explained. Picture trying to pay off one credit card by opening a second credit card, then paying off that second card by opening a third. That sounds absurd for a household. It's uncomfortably close to how sovereign debt actually functions. When old government bonds mature, the Treasury doesn't simply pay them off from a savings account. It issues new bonds to raise the cash to pay off the old ones. As long as investors keep buying, the machine keeps running. But here's the catch. As total debt grows and as interest rates rise, the cost of issuing that new debt grows too. More of the federal budget gets consumed just paying interest, leaving less room for everything else, and increasing the pressure to borrow even more next year just to keep up. Economists have a name for what happens when this cycle starts feeding itself, a debt spiral. Not a single event, but a slow compounding trajectory, each year's deficit making the next year's deficit structurally larger, almost independent of policy decisions. This is the mechanism quietly running underneath the headlines. Not a single villain to blame, not one irresponsible president or Congress, a structural feedback loop that keeps generating pressure to expand the money
supply, no matter who's holding the pin on the budget. Which brings us to the actual fuel behind rising prices. Money supply, explained simply. Here's the simplest way to understand inflation that almost nobody uses. Imagine an island economy with exactly $100 in circulation and 100 loaves of bread for sale. Each loaf costs roughly $1. Now imagine the island's central bank creates $100 more overnight without a single additional loaf being baked. Suddenly, there are $200 competing for the same 100 loaves. Prices don't need a conspiracy to double. They just do, mathematically. That's the essence of what economists track using something called M2, a measure of all the cash, checking deposits, and easily accessible savings circulating through the economy. As of early 2026, M2 in the United States sits at an all-time high of roughly $22.6 trillion, having climbed dramatically over the past several years. More dollars chasing a relatively similar amount of goods and services. That's the island, scaled up to the size of the largest economy on Earth. And where does that new money actually come from? Largely from the same mechanism we just described, government borrowing, absorbed in part by a financial system that has the unique ability to create new money to buy that debt when private demand isn't enough. Economists call this process quantitative easing, essentially using freshly created money to purchase bonds, injecting new liquidity directly into the financial system. The opposite process, quantitative tightening, is supposed to work in reverse, pulling money back out. But pulling money out of a system that has grown structurally dependent on it turns out to be far harder than putting it in. Which brings us to the tool everyone assumes is the actual solution. Why interest rates aren't enough. Interest rates get treated like a light switch. Flip it up, the economy cools. Flip it down, the economy heats up. For
Borrowing, mortgages, car loans, credit cards, that's roughly true. Higher rates from the Federal Reserve, currently sitting at 3.75%, make it more expensive to borrow, which in theory slows spending and cools inflation. But there's a problem hiding in plain sight. The government is by far the largest borrower in the entire economy, and higher interest rates don't just slow down consumer spending, they directly increase the government's own interest bill on trillions of dollars of existing and future debt. In other words, the very tool used to fight inflation makes the government's core financial problem worse. That's not a minor side effect. That's a structural contradiction sitting at the center of the entire system. The Federal Reserve is asked to fight inflation using a lever that simultaneously accelerates the government's debt burden, the debt burden that inflation was quietly helping to shrink in the first place. This is why raising rates can never be a permanent solution. It's closer to squeezing one end of a balloon while the other end quietly expands. So if the tool everyone points to isn't actually a fix, what does that mean for the average person watching their grocery bill climb? Why this matters to everyone. Here's where this stops being an abstract policy debate and becomes personal. If the system is structurally leaning toward a certain amount of ongoing inflation, that means cash sitting in a low-interest savings account isn't neutral. It's quietly losing purchasing power, year after year, by design, not by accident. This is why, historically, the people who've built lasting wealth haven't simply saved dollars. They've owned things, businesses, real estate, productive assets.
that tend to rise in value alongside the money supply, rather than sitting still while it expands around them. It's not that saving is wrong. It's that understanding the water you're swimming in changes how you think about where to keep your
prices, measured by the CPI, the Consumer Price Index, and the PCE, the Federal Reserve's preferred inflation gauge, aren't random noise on a chart. They're downstream symptoms of a much bigger structural current, a government that must keep borrowing, a debt load that benefits from a shrinking dollar, and a central bank caught trying to manage a contradiction it didn't create and can't fully resolve. Once you see the current, the individual waves make a lot more sense. What happens next? So where does this actually go? Nobody can predict the exact path with certainty. Anyone who claims otherwise is selling something. But the structural forces we've walked through don't simply disappear on their own. Government debt continues growing under current projections, potentially exceeding $50 trillion within the next decade under baseline estimates. Interest costs are projected to keep climbing as a share of the federal budget, and the fundamental tension between fighting inflation and managing a debt-heavy government doesn't resolve itself just because a headline changes. That doesn't mean collapse. Economies with far higher debt-to-GDP ratios than the United States have functioned for decades. But it does mean the pressure we've described isn't going away. It's the quiet backdrop against which every future interest rate decision, every deficit debate, and every inflation is easing headline will keep playing out. Understanding that backdrop doesn't mean living in fear of it. It means finally seeing the actual shape of the problem, instead of chasing its shadow every time it shows up as a price tag at the grocery store. So let's go back to where we started. Everyone blames inflation. Politicians blame inflation. The news blames inflation. Even the Federal Reserve, in its own way, treats inflation as the enemy to be defeated. But inflation was never the disease. It's the visible symptom of something built directly into the architecture of modern money. A system where debt keeps compounding, where a shrinking dollar quietly makes that debt easier to carry, and where the tools designed to fight rising prices are the same tools that make the underlying debt more expensive to hold. You don't fix a structural design flaw by adjusting a single dial. The problem isn't inflation. It's the system that makes inflation inevitable.